Could you able to see the screen, sir?
Yes, sir. We can see, sir. Now the exam is offline, sir. They have to come to campus and write. No more online exams, sir. Or PG there. So we have to. They have to learn everything in detail, sir.
Actually, I attended a yeah, friends. We have been talking about this, investment management and portfolio management, and actually that unit 5 basically consists of portfolio analysis and portfolio selection, capital asset pricing model, and portfolio revision, and portfolio evaluation, and mutual fund. These are all the area where mutual fund already we have discussed. This subject we kept it as a last because this portfolio is an important topic, and so last time I have taken on a macro level how overall portfolio should be done. Now we will go one by one. This is an important subject. I request everyone to be more attentive. And I'm really sometimes, I mostly upset that nobody asks any question and nobody clarifies any doubt. Of course, I am upset on that front, but I have no choice, because ultimately it is you that you should learn what you want. And unless you are inquisitive and whatever the pressure I give, I don't think that will work. Okay. And so up to you to learn the habit of understanding things, as well as ask a doubt and clarity to have a better in-depth knowledge. Okay, friends, when we talk about the portfolio management, the revision, construction, evaluation, everything, we have to first understand what is investment. An investment operation is one which, upon through analysis, promises of safety of principal and an adequate return. In my first session with you, I have told you about the simplest way. The golden principle of investment is that safety, liquidity, and return. When we talk about construction of the portfolio, that first we have to keep in safety of principal and an adequate return. That is what the most important. Okay. So when we do the investment, we need to have a little bit planning. What for we are saving? Because actually this is a third time I'm repeating the subject, and so that you will have a better understanding on this area. So we have to think of what is the purpose of the investment. So what purpose we do the planning? See, normally when you do at the life cycle, it is a first 22 years for anyone, from the date of birth, when you complete your education, by the time it will be 22 years. That is not a period of income. That is a phase 1. People build their knowledge and get ready for going for employment and income. So from 22 to 60, that is almost 30 years, 38 years is the major part of our life, where we do earning, where we do savings, where we do investment. What are the purpose which we have to invest and save? Probably the marriage, childbirth, we need to have a housing, then we need to have a child education and child marriage. Then finally, the next phase of that beyond 60, and then we need to have a retirement, and we need to have a goal of how to have a comfortable and healthy retirement life. So you divide the human life cycle into part 3. Part 1 is adult. Part 2, that is a phase 2, is almost around 38 years of a high profile of employment and earning, savings, investment, and all these things. And the next one is plan for retirement. So we have to develop a well-defined goals, divide the goals into short-term and long-term goals, look at the current income, expenses, and savings, and map out well-defined strategy to turn the dreams into reality. So the planning is that we have to goal-based planning, and we need to have a short-term as well as a long-term goals. And all these things ultimately based on our income and expenditure and how much we are able to save. And once we do that, we need to have a proper strategy. Then only the savings will that reality. So identifying the investment objectives, as I told you in the first phase, what is the needs and requirement, and determine the required returns to meet the financial objectives. What do you mean by that? For example, if I am a bachelor, I started my savings at the age of 22. If I am going to get married around 28, how much money I would like to have it for my marriage, or how much money I need to have spent for my children's education, then required amount, required returns. So based on that, we have to decide how much we have to invest. Then with all these things, the important things when we do the portfolio for every individual, it is not a uniform pattern that we should do for everyone. We have to plan the PMS based on the individual risk tolerance, because all people do not take the same amount of risk. Some people want to have a more risk, some people want to have a less risk, some people never wanted to have risk. So that we have to determine each. See, that is what I said, that PMS is a specialized product. It is not a common product. It is not a general product. It is a ready-made for, it is not a ready-made. It is tailored for each and every one. Okay. So they design and asset allocations to meet the risk and return. So based on the risk tolerance, and we need to allocate the assets. Asset means what? Where we are going to invest our savings, and what should be the each asset class will give us a return, and what is the risk it is associated. Okay, then we can always modify that asset allocation based on any change in the needs or in the risk tolerance. Okay, so that when we do the retirement planning, an assessment of financial status, and ascertain post-retirement needs, and determine what you need to save and how much you have to save, and find extra money for the savings. For example, see, I am going to retire at the age of 65, but every month I require almost around the 50,000 rupees per month for my family expenditure, or a 1 lakh or a 2 lakh, whatever may be the next amount. If I want to earn monthly 1 lakh rupees at the time of my age of 65, then if I am at 45 now, another 20 years we have, the 20, how much I should save now to get back that 1 lakh rupees every month. That is what the most important in this point. Okay, and also we have to plan for how much the tax will go into the savings as well as when we realize the returns. Is another important point, especially the salaried class people, that what is the exemptions are available and how much they can save the tax if they do an investment in certain areas. Okay. So what is the investor goal? Is the investment for retirement, or down payment on a house, or child education, or a second home, which already we have seen. So what is the goal? So then based on the goal, we have to do a comprehensive platform of tailor-made services, okay, customized strategies and product application, the highest quality in advice and confidentiality, a single point contact and personalized service, and an experienced investment advisor, resources and capabilities to ensure timely and accurate execution. This is an office setup a PMS person used to have. Okay. Now I'll come back and give you the picture of, that how much money do you need to be financially independent? As I told you earlier, when your age is around 35, and that status is married, and you have the children, child of 5 years and boy of 3 years, considering the inflation at a rate of 6%. Now, this is what your total, that to the rupees. and corpus required, and how you can plan. So monthly fixed expenditure is a budget in today's rupee, groceries of 10,000 rupees, utility of 15,000 rupees, monthly discretionary expenditure of 5,000, and the life cycle clothing 2,500. So annual expenses like motor insurance, health insurance, all these things. So this is what you need. And in today's rupees, 5,27,000 rupees in today in terms of at retirement due to inflation, assuming that you are retiring at the age of 58 years. So now you are 35, you are going to retire at the age of 58. That means 23 years you have. See, today's 5,27,000 rupees of your income is equivalent to 20 lakhs rupees at the age of 58. That is after 23 years. Okay, you get my point, friends. That means if you want to have this kind of a monthly expenditure, you require a corpus required at the time of retirement is around 5 crore rupees. So you require 5 crore rupees. If you do investment of 5 crore rupees on the date, then you are likely to get your monthly expenditure. That means your earnings should be on an average of around 8.8% per annum. In a 70% of debt and 30% of equity portfolio, you are able to gain. This is the indicator. Okay. So if you do have 8.8% income on your 70% of your investment, then you require 30% portfolio in equity. This is called an asset allocation. See, that is what, when you have so much, 70% you are investing in a debt securities and 30% you are investing in a equity portfolio. So that this is what normally, how much money you require. Based on that, you try to do your investment. Okay. Now we know how much we need to invest, how much you want, how to determine the investment style. Okay, there are two kind of things. What you need to understand is that when you do a investment, what is the risk and what is the amount of time, and how much time you require. If you have 10 years, you have 5 years, you have 60 years, you have 70 years, and what is the time duration, time horizons, and what is the risk you are ability to take. So what do you mean by risk tolerance? What do you mean by risk? See, how comfortable will you be seeing your investment decrease in the near term while waiting for it to increase over a long term? That means, for example, today I invest in an equity instrument at 1,000 rupees. Whereas tomorrow it goes to 990, 950, 960, 900. There may be a decrease, but I should not get upset over it. Okay. That means that I know that I'm taking enough risk. There may be a downside, that share value may go down another 20%. Still, I'm comfortable because I expect a long-term return over a period of time. So instantly, I am ready to take the risk of even going lower than what my investment changes. So how comfortable will you to invest something in which the price changes every day, sometimes adverse? So this is what, the risk. The value of my investment may adversely have an impact on my portfolio, but I am ready to take that kind of risk. That is the risk means the portfolio or the asset where you invest, even if it goes down, I am ready to bear that. That is called a risk tolerance. Okay. So there are various degrees of risk across the investment spectrum. From the government savings bond carries only a sovereign risk and a credit risk, which are considered risk-free as they are guaranteed by the government, to equities, commodities, and options where one can lose significant amount of the invested money. Okay, so there is a degree of the volatility or a risk, which depends on each one. Okay. So the second factor is the time. How much time you want to or able to spend on investing? You are going to 20 years or 10 years or 5 years. Okay. So that more important, how active do you want to be in the management of money? Are you an active investor or a passive investor for a period of investment? If somebody starts early at the age of 23, 24, 25, that means you have almost around 40 years. So that still you can do more investment, more risk, and more ups and downs. Still you can do that. If somebody want, no, I cannot wait for 20 years. I want to do all these things in a 5 years time. Then in the case, that you have to plan such a way. So it depends upon the risk. The number two is the time. How much duration you would like to have a fruits of your investment. Then that based on that you have to decide. And this is what more important. Okay. Now you are coming to the next area of where to invest. Now I just recollect what we have discussed so far. The first point is that the safety, the investment, the savings, safety of our investment style. We need to have the safety and adequate return. Then we need to do the investment based on goal based. How the goal will be set? The goal is based on the requirement of each and every person's. Maybe for a house, maybe for a vehicle, maybe for a children marriage, like that. Then once you decide that, we have to do the strategy that how what is the duration for which he is ready to do investment and what is the risk tolerance. Okay, this is what we have discussed till now. Now, where we are going to invest, what are the opportunities that are available for the investment? Okay, that's what now we have to think about. There is I put this way that this is the return, the low return, this is high return, from low to high. Okay, what is the zone? Bank to fixed deposit, mutual fund, liquid fund, and that companies fixed deposit, post office saving, government securities, RBI bond, like that. These are all mostly fixed income securities where you have a low risk and also low return. Okay, the risk is low and also return is low. But if you want to be an aggressive stance, you have a mutual fund like an income fund, a gilt fund, and balanced fund, index fund, growth funds. Still, you want to be more aggressive and more the risk you try to take, you can go into the equity. So this is an order of that riskless and risk-free and risk increasing. These are all the opportunities available for anyone who can invest. Okay. Now, when we talk about the product, what do you do that when you do the investment in stock, what kind of return you get it? You get a dividend and also get a capital appreciation. Whereas in the case of bonds, you have safe revenue of return by way of interest. Whereas in the case of real estate, it offers the rent as well as the capital appreciation. In the case of precious metal like gold, silver, copper, crude oil, natural gas, so many things, it appreciates over a period of time and or a hedge against uncertainties. And also insurance is also a risk associated risk hedging investment product used as a securities against the risk of uncertainties. Okay. Now we have seen that what is the savings, what is the investment avenues, what is the goal, what are the opportunities are available, what is the risk, everything. Now, how to construct the portfolio? That means how the portfolio needs to be. And basically, the construction of the portfolio means it's called an asset allocation. That asset allocation is a strategy by dividing the portfolio among various asset class so as to obtain the desired portfolio characteristics to suit a distinct investor profile. That is what from the beginning I have been telling you, that each investor profile is different, so that we have to prepare a distinctive investor profile based on that portfolio asset classification should be done. Okay, see here, bonds, stock, and cash equivalents are the most commonly used asset class in any asset allocation. It is an organized and an effective method of diversification. See here, the major portion goes into bonds, that is called a fixed income securities. And this portion you have the cash. This is what investment in stock. Okay. So this can be changed based on the investor's willingness to take the risk. Then when we talk about, that equity, this portion again, this equity portion again, we can divide into small cap securities and mid cap securities and large cap securities. So that you divide, you almost, distribute your asset in various sectors and various cases of market cap allocation, so that you are spreading your risk. And then again, when we go into the mid cap, small cap, and large cap, again, we come into sectoral allocations. Which sector I would like to invest? For example, auto ancillaries, and the IT, and materials, and capital goods. You have a pharma, like that. You have cash, liquid funds, mutual funds, stock chemicals. There are sector-wise allocations. So all these things, we are right now talking about allocation of the risk. How you do that? We have to do a proper research, proper security analysis. That is the reason I have taken a class for you that in advance, prior to this session, to understand what is a security analysis. Without doing a security analysis, we cannot do any asset allocations at all. And we cannot choose the respective script. Okay. So that the most important determinant is the portfolio return on asset allocation. And that without allocations, you cannot. Then how you do the security selection and when to invest, market timings and other factors or the key determination when you do an investment. Okay. When you do the asset allocations, the selection of the asset class, proper blending of these asset classes in the portfolio, managing the asset mix over a time, so that whether I can go for a metal, whether I can go for a cement, whether I can go for a steel, or I go to pharma, I go to construction or a consumption or a capital goods, so on. So that can be over a period of time, that can be mixed depending upon the portfolio things. See here. As I told you, the life cycle of investment guide is that you are in the mid-20s. That shows that if you are in 20s, then you can go for a 65%, where the stock, then you can go for a real estate and go for a cash and go for a bonds like this. That means that when you are young, then you can take 65% of, you can take the risk of investing in a stock. And whereas 20% you can go into the bonds, because that, and then you can have a cash and the real estates. Okay. But when you go and move into the 30s and then late 30s, then slowly from 65% to you are reducing to 55%. Then you are increasing the debt investment. You are trying to reduce little risk, go for a more safer job. Whereas here does not change, 10 or 5 does not change. And so this is how you have to, depending upon your life cycle, and we have to do the investment constructions, portfolio constructions. Okay. Sorry. So when you go for mid 50s, that, see again, from 65, I reduce 55% my exposure in the equity, and then I reduce another 11%, 10%, is 44. So that I increase my stock in, bonds and debt investment. Then I increase little bit on the real estate. And when I cross the 60s, I reduce my equity portion to 25%. I go for more than 50% in my debt stock. That means a fixed income security. That means that what it conveys the meaning, friends, that when you are young, you can take more the risk, try to increase your income. So your risk appetite can be more. But when the age goes on, you can reduce the risk appetite, try to increase a safer mode of investment, even if there is a less return, move into the lesser risk oriented. So that is what the risk and return are associated. So when here you take the more risk, you may get a more return. Here you take the lesser risk, you get the lesser return. The risk and return are always related. The risk depends on the length of the time you want to hold on the investment, whether it is a 5 month horizon or a 5 years or a 10 years or a 20 years, depends upon how the risk perceived. And the rupee cost averaging can reduce the risk of investing. There is called a risk, the rupee cost averaging method to reduce the risk. The risk that an investor can take depends upon the investor capacity to take the risk and his attitude to take the risk. This is what I am explaining. I am insisting this point again and again because ultimately risk vary from person to person, asset to asset. So depending upon when you are, for example, after your MBA, when you become a portfolio manager, you can construct the portfolio based on each individual's risk and the expected return and the period of, the PMS going to be. So now we will come to that. What is the strategy to do the asset allocation? Strategic asset allocation is a method that establishes and adheres to is called a base policy mix. This is a proportional mix of assets based on expected rates of return of each asset class. Okay, you get my point. So it's again a policy mix. How strategy I do that is how strategically I do my asset allocation based on expected rates of return. Okay. In the short term, the investor may occasionally engage in a tactical deviations from the mix in order to capitalize on unusual or exceptional investment opportunities if it is a short term. So there is a tactical deviation. What is a deviation? We are going to discuss in the coming slides. That this flexibility adds a component of market timing to the portfolio, allowing investor to participate in economic conditions that are more favorable for the more performance of one asset class than others. What do you mean by that? Allowing investor to participate in the economic conditions that are more favorable for the performance. Right? What do you mean by that? Then when you do the performance of each asset class, whichever is doing very well, which are more favorable performance, you try to have again, that allowing investor shift from one to another so that you maximize your income. What is a tactical asset allocation can be described as a moderately active strategy. What do you mean by that? Means active means moderately active. That means I don't keep my investment stock just like that. I review every day depending upon the performance of each asset. I need to have actively reshuffle and shift or hedge and actively managing the portfolio so that I try to mix the return when it's desired short-term profits are achieved. So this demands some discipline from an investor or the portfolio manager, as he or she must first be able to recognize when the short-term opportunities have run their course and then rebalance the portfolio to the long-term asset position. You understand, friends? That means that you need to have a discipline. What do you mean by discipline? You need to stick to your objectives and strategy. You cannot just like that. For example, see, there is an opportunity that tomorrow there is an interest. One person is asking for an interest at up to 24% for a period of 10 days. Okay, that gives a better return than me. Then I can strictly go into that asset and take more, then bring back to that long-term asset propositions, so that I can always rebalance my portfolios to avail the short-term benefits as well as the long-term benefits. Okay. And so the dynamic asset allocation is when the mix of assets is constantly adjusted as the market rise and fall, the economic strengthens and weakens. What do you mean by that? When you do an asset allocation, there are two ways to manage. One is that I just allot my assets and keep quiet. I invest in the cement sector, steel sector, this sector, micro, these, all these things, pharma, I do. I keep quiet because I have done a proper research and based on that, I do my investment. Now, last week, for example, the budget came. So budget have got some provision for the digital economy, and you know that there is a customs adjustment for the metals, a lot of things. Now, based on that, I should be able to reshuffle my portfolio depending upon the market trend and the economy strength and weakness. So that is called a dynamic asset. I immediately get out of some stock and get into the stock which are favorable based on the economy, based on the budget allocations like that. Okay. So if the stock market showing a weakness, stocks are sold in anticipation for further decrease in stock value. And if the market is strong, the stocks are purchased in anticipation, continued gain. Okay, you understand that the idea here I am explaining is that when you do an asset allocation, there is a dynamic asset allocation and there is a constant, static asset allocations. Are you dynamic or static depending upon the strategy what we try to do? Which asset allocation style is the best? Okay, it will be normal asset allocation or a dynamic or a balance or active or a passive. What is the best? We cannot say which is best, which is not best. So the asset allocation can be an active process in varying a degree in strictly passive nature. There is a varying a degrees or a strictly passive nature. What do you mean by passive? I just simply invest and keep quiet. Ups and downs, I don't bother about it. Okay. Okay, are you clear? So the choice of prices, precise asset allocation strategy, or a combination of different strategies depends upon one's goal, age, and risk tolerance. So what style you should follow, it depends upon you want to be an active process or you want a passive. The strategy can be decided based on one's goal, age, and risk tolerance. So I cannot have an active or a dynamic asset allocation when I am at 60 or 65. Whereas when I am in your 40s, I can always do that kind of things. So the general guidelines on how investor may use asset allocation as a part of their core strategies. So ultimately, again, based on the strategy, how fast I can do that. Now, allocation approaches anticipating and reacting to market movements require a great deal of expertise and talent in using the particular tools for timing these movements. Okay. It depends upon, that the market movements you need to anticipate. It's not an easy job. You need to watch it properly. You need to do that. For example, that the government is coming with an announcement of cleaning of the bank balance sheet, clearing all the non-performing asset into the bad bank. That means that the bank's balance sheet will get clean and there will not be any MPA and there will be a normal process. So the balance sheet is strength. So this is happening in the market. So what I have to do, I have to immediately shift my things more towards the financial industry, financial sector, more banks, because that they expected to do well in the coming days. So based on that, I can always move my dynamic allocations from one to another. So this is what we have to do, that dynamic asset allocation. Okay, friends, now we have discussed about what is asset allocation. Now, how fast we do. Evaluate the investment options. What are the options I have? How to evaluate my options? So this is where you come into research. Okay, you have to research your investments. Once you know how to invest, and it is time to figure out where to put your money. Okay, so I go back again. That this asset allocation is more important. For asset allocation, you need to have a base of policy mix. Then you need to have, tactical asset allocation based on active strategy or a passive strategy. Then when you do the dynamic asset allocation, depending upon the performance, okay, then which is the best? We cannot say which is best, which is not best, and depending upon the age and everything, we have to decide. Okay, now I have an asset allocation strategy, and also I have decided to go for an active management, dynamic portfolio choosing, everything. So what are the options available? How to evaluate my options? So that gives now come to the part of the research. If you are a good portfolio manager, you should know how to do the research, how to identify the stock where we can invest our money. This is what is the figure out where to put your money. This is more important part. How to invest and where to invest. This is and when to invest. This is what more important. So then when you do that, what I should know when I do the research, what all things I should know. When you do the research, dear friends, you have to understand the historical trend of the particular stock. You need to discover historical trend. This is what where we discussed about, that technical analysis. In the technical analysis, you get all kind of historical data, and you do the perform financial analysis. First, you have to discover the trend. Then you have to perform the financial analysis. That is from the balance sheet. That is called a fundamental analysis. So based on the trend, what you decide is purely based on the technical analysis. When you do the financial analysis, purely a fundamental analysis. Now compare with the peer group. What do you mean by that? For example, you decided to invest in a cement industry. Okay. So when we do a cement industry, where is a cement? Okay, I decided to invest in a cement industry. Then where to which company I can invest? Can I go for an ACC? Can I go for Gujarat Ambuja? Can I go for L&T? Or can I go for which kind of, that India Cement? Which one I will do? Same way when I want to go for an auto, then can I go for a Mahindra? Can I go for a Tata Motor? Or can I go for an Ashok Leyland? So they compare with the peer group, so that then you will find which one is better, whether ACC is better or L&T Cement is the better, or Gujarat Ambuja is better, or what else, India Cement is the better. Then when you do comparison between, the companies based on the historical trend as well as, financial analysis, you will come to understand the peer group. Then again, you have to relevant economic news. What is going to happen in the cement industry over a period of time? And what all the economic events are happening on the particular industry and also particular company. Then we have to forecast the future performance based on the past trends, and we can decide about the future. And then we have to take the recommendation of the experts. That is what you have to do the research. Now, once you do that, you have to create your portfolios. The asset allocation decision has been made. The second step is to select individual securities and build portfolios for each of the asset class under consideration. So once you decided asset allocation of 15% to a cement industry, right? What is the second step? You have to select individual securities and build a portfolio range of asset class under consideration. Okay. So the process begins with selecting securities from the investment, and then process begins with the selecting securities from the investment options in the asset class and adding the selected securities to form portfolios. Okay, you understand? The first asset allocation. The second step, select the sector. Third one, select the individual securities, then started investing. Okay. The process begins while selecting the securities from the investment option in the asset class and adding the selected securities to form the portfolio. Now then again, you are coming into the real mathematical calculation of the standard deviation of your portfolio decreases as the securities are added, because they would not be perfectly correlated with your existing portfolio. So you have to now come with a specific working of standard deviation. And then based, because for example, when you invest in a cement, you invest in 1,000 share, that your percentage of the total portfolio is different. When you add another 10,000, then the perfect correlations will be different. When as and when the portfolio decreases, as securities are added, in the overall from the 100%, if you are having a 10% of cement, but when you add, that more, it will become a reduced percentage in other sectors. So expected return of the portfolio will remain relatively constant. So you have to always maintain your standard deviation of each portfolio. So eventually the diversification benefits of adding more securities disappears after about 10 securities. For example, in large equity portfolio, or that the standard deviation tends to coverage to 20%. For example, that see, when you invest 1,000 rupees in one stock, it is 100%. When you add a 10 stock, then it becomes, that it become a 20%. So that it become a converge from 100% to 20%. Where this is still applicable in the case of larger securities. Okay. Now we are just in the process of creating a portfolio. Let us now create a portfolio of stock A and a bond B. Stock A is expected to deliver a return of 20% per annum with a volatility of 25%. Okay, you get my point? When you invest in a stock A, that will give annual return of 20%, but the volatility of stock is 25%. You have to consider all these things. Okay. Now, when you invest in a bond, it is expected to deliver a return of 6% with a volatility of 5%. You understand, friends, here? So the return of 20%, but the volatility is at 25%. Here, return of 6% with the volatility of 5%. Now, if you allocate the asset in equal proportion, for example, 50% in stock A, 50% in bond B, then the resultant benefit portfolio is expected to deliver return of, do you think that it will give 50% return each? No. See that 0.5 into 20% and plus 0.5 here, the volatility, and into 6%. That means that equal to 13%, the approximate volatility of 15%. This is what we have to understand when we create a portfolio. Okay, are you clear? These are all little bit we are moving into a technical areas. So far, what we have discussed about, is a general concept of how to build a portfolio, how to do asset allocations, and what is the method, strategy, what we do. Now, when you create a portfolio, when you do an asset allocations, and what kind of reshuffling, what kind of percentage, the risk and return are associated based on its volatility. Okay. Now, if we change the asset allocation to 25% in A and 75% in B, then the resultant portfolio is expected delivery of 9.5% with an approximate volatility of 10%. Friends, understand here, when you do 50% is high volatile and 50% less volatile, your return is 13%. Okay. Whereas when you move into 25% in a high volatile, 75% in less volatile, your return comes down to 9.5%. Now, are you clear? So how much we have to do? Is it a more volatile and more risk and then more return? If there is a less volatile and less risk, is a less return. So this is what we need to understand while we do the portfolio construction. Very clear? These are all very, very, deep related subjects. We have to do practically workout. We have to do exercise on this. And unless we work practically, that we will not understand. There are two ways getting things. One is that either just for your examination point of view, I just understand this, I write my exam, go ahead. That is one way. Or if you're really interested deep into the knowledge and about the PMS, tomorrow you want to select your career in the PMS, then you need to do project work. You need to work on that. Then only you will understand this better. Okay. Now we will move into how that characteristics of asset class. So the purpose of using various risk, and you know that portfolio is a reduction and the risk through diversification, and you know what is the risk categories and how the risk can be diversified, thereby enhancing my risk and return ratio. So this is what diversifying, for example, 50% here, 50%. Here it is a 25%, 70. I am diversifying based on the risk categories of the portfolio. So proper allocation of assets in a portfolio begins with determining the portfolios, determining the proportion of the total portfolio to invest in each asset class. Okay. Are you clear? See, now this is how your return and the risk percentage, that is called a standard deviation, works. How much risk you can take, and when you more the risk, how the more the return will generate, and the lower the risk, what kind of an asset class you can go, and higher the risk, what kind of an asset class you can do. Okay. Now, so lower the risk, the return is also here. The risk is lower, the return is lower. What is that? It's a money market instrument. Government treasuries will have a lower risk and lower return. And investment grade corporate bonds, this is a little higher risk and a little more return. And you take more return, blue chip and large cap equities. And you know that this is a moderate risk you are taking and moderate return you are getting. And you can go for a mid cap equities. When you do your mid cap equities, you get better return than all these things, but you are increasing your risk percentage. And when you go for a small cap equities, will have higher and risk and higher than return potential. So this is how to maximize your return and minimize your risk. And it all depends on what kind of strategy you do that. Okay. So the risk return characteristics of asset class, it helps to evaluate the behavior of the asset class over a different economic cycle. Because you want to study the characteristics of every asset class. How to do that? You have to understand the behavior, means you have to go over the different economic cycles. For example, sugar industries or a textile mills. So these are all seasonal in nature. Then you understand the behavior of the sugar industry. Will do well maximum for 9 months when the can came for a crushing. The rest of the things, it goes into the maintenance, you may not have an income at all. So that is the characteristics of behavior of that sugar industries. Same way, depending upon the the steel, when you talk about the steel, how the raw material prices, iron ore, steel scrap, what is the duty structure, and so on. So that the more representative of the return that investor may have expected to earn over the period. Get my points, folks. So that we have to understand the characteristics and behavior that is called behavioral economics. When we read in behavioral economics, we understand each kind of an asset class, how it will behave over a period of time. So it will useful in establishing benchmark as to what returns investor might be expecting to earn in future. And also availability of realized return and risk measures can be used to compare the relative performance behavior of asset classes. So step by step, we are going into the inside of constructing the portfolios. So that when we understand, product, we have to understand the behavior and characteristic of each asset class, when it will boom, when it will not, when it will go down, when it will perform well. Based on that, I can do it dynamically. I can change my asset portfolios. Okay. So this is in the simplest way that how the each asset class, what is the characteristics of asset class. For example, cash equivalents, that like a fixed deposit or so on. With the short-term maturities, what is the form of return? It's an interest. What is the risk? Very low. Whereas in the case of fixed deposit, it's a maturity with a long term. What do you get? You get by way of interest. What is the risk? Is a medium. Government securities, long-term maturity, interest earning, medium risk. Corporate bonds, long-term, interest, medium. When you come to a preferred shares, perpetual, what is the income? It's a dividend and moderately high risk. So from low risk, you are coming to medium risk, then medium, then moderately. Then when you move on to the equity shares, this is a perpetual. And you know that dividend and capital gains are the most relevant income return from this equity investment, and but the risk is very high. Okay. You get my points. So this is what, each asset class characteristics. Okay. With this, we will stop today. And if you have any questions till whatever the subject we have covered, if you have any questions, another 5 minutes is there, then we can discuss that. Okay, if there is no question, we can wind up the session, and then the balance portion we will take it tomorrow. Okay. I think that no one is